Hey there, ever wondered if you're leaving money on the table by not optimizing your Acorns contributions? We all know the drill: invest early, invest often. But when it comes to micro-investing platforms like Acorns, does the frequency of your contributions, monthly versus weekly, truly make a difference to your bottom line? Is one method inherently superior, or is it more about finding what fits your financial rhythm? It's a question many of us ponder, whether we're seasoned investors or just dipping our toes into the world of compound interest. We sign up for Acorns, we link our cards, we set up those roundups, and then comes the direct contribution decision. For some, it's an automatic monthly transfer, a set-it-and-forget-it approach. For others, it's the weekly drip, a more frequent, perhaps more granular, way to funnel money into their future. But beyond personal preference, what do the numbers say? Are we talking about a negligible difference, or could optimizing this one small aspect of your Acorn strategy unlock a surprisingly significant boost to your portfolio over time? Today, we're diving deep into the fascinating world of contribution frequency on Acorns. We're going to break down the arguments for both monthly and weekly contributions, explore the psychological impacts, delve into the power of dollar-cost averaging, and even run through some hypothetical scenarios to illustrate the potential outcomes. By the end of this video, you'll have a much clearer understanding of which approach might be best for your financial goals and how to squeeze every last drop of potential out of your Acorns account. So, let's get started. Let's begin by understanding the core mechanics of Acorns. For those unfamiliar, Acorns is a micro-investing app that helps you invest spare change from everyday purchases by rounding up transactions to the nearest dollar. It also allows for recurring contributions, which is what we're focusing on today. You can set up automatic daily, weekly, or monthly deposits, in addition to those roundups. The beauty of Acorns lies in its simplicity and accessibility, making investing less intimidating for millions. Now, why does contribution frequency even matter? Isn't a dollar, regardless of when it's invested? Well, not exactly. The key concepts at play here are dollar-cost averaging and the magic of compounding. Dollar-cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price fluctuations. This strategy helps to reduce the impact of volatility. When prices are high, your fixed contribution buys fewer shares. When prices are low, the same fixed contribution buys more shares. Over time, this averages out your purchase price, potentially reducing your overall risk and leading to a more stable return. Compounding, often called the eighth wonder of the world, is the process where the earnings from your investments generate their own earnings. It's interest on interest. The earlier your money is invested and the longer it stays invested, the more time it has to compound, leading to exponential growth. So, how do these concepts play into monthly versus weekly contributions? Let's break down the arguments for each. First, let's look at the case for monthly contributions. This is often the default choice for many, and for good reason. It aligns well with most people's pay cycles. You get paid monthly, you set aside a portion for investing, and it's a neat and tidy system. One of the primary advantages of monthly contributions is simplicity and psychological ease. It's less frequent, meaning fewer transactions to track, though Acorns does most of that for you. For individuals with less consistent income or those who prefer to budget on a monthly basis, this can feel like a more manageable approach. It allows for a larger, lump sum contribution once a month, which for some, feels more substantial and impactful than smaller, more frequent deposits. This can also reduce the feeling of nickel and diming your bank account, which some people find off-putting with very small, frequent transactions. Monthly contributions also make it easier to align with other monthly financial obligations. You pay your rent, your utilities, and then you invest. It fits into a traditional budgeting framework. For example, if you aim to invest $200 a month, setting up a single $200 transfer is straightforward. However, the main potential downside of monthly contributions, when compared to weekly, comes down to the frequency of dollar-cost averaging. With only 12 contributions a year, you have fewer opportunities to average out your purchase price. If the market experiences a significant dip just before your monthly contribution, you might miss out on buying more shares at a lower price for that particular month, only to see the market rebound before your next contribution. Conversely, if the market spikes just before your contribution, you might buy in at a higher peak. While this effect might be marginal in the long run, it's worth considering. Now, let's turn our attention to weekly contributions. This approach, while seemingly more frequent, offers some compelling advantages, especially when considering the principles of dollar-cost averaging and compounding. The most significant benefit of weekly contributions is enhanced dollar-cost averaging. With 52 contributions a year, instead of 12, you are significantly increasing your opportunities to buy into the market at various price points. This greater frequency inherently smooths out the impact of market volatility. If the market drops midweek, your weekly contribution will buy more shares at that lower price. If it rises, you'll buy fewer. Over time, this increased frequency typically leads to a more favorable average purchase price, potentially reducing your overall risk and improving your returns, particularly in volatile markets. Think of it like this: imagine the stock market as a roller coaster. With monthly contributions, you're only getting on the ride at 12 specific points. With weekly contributions, you're getting on 52 times. This gives you many more opportunities to catch the dips and benefit from the subsequent rises, without trying to time the market, which is notoriously difficult even for seasoned professionals. With that said, thanks for watching, and until next time.